Welcome to Performance Optimization Strategy Advance. Myself, Srijit Kakkar. For more information on our products and courses, you can visit www.srijitkakkar.com. Before moving ahead, please make sure you go through the disclosure. I will keep it on the screen for some time. Performance Optimization Strategy Advance Part 5. Advanced Boosters, adding more probability to your trades. Let's understand three advanced boosters: traps, level on top of level, and coinciding level. Traps are demand and supply zones where, based on conventional technical analysis, traders start making the novice mistake of buying expensive or selling cheap. When traders make these mistakes, the zone can work like traps. Based on conventional technical analysis, traps can form due to multiple reasons, like violation of day high is a buy signal, violation of day low is a sell signal. Therefore, break of day's high or low can create a trap. Breakout of chart patterns like double top, double bottom, head and shoulder, inverse head and shoulder, etc. can create traps due to chart patterns. Buy-sell signals can be based on moving average crossovers and create traps. Breakout of pivot high is a buy signal. Breakout of pivot low is a sell signal. Therefore, pivot highs, pivot lows breakouts can also create traps. Conventional technical analysis is a very vast subject. Since we only want to use it for identifying traps, we will use the most commonly used conventional technical analysis approach. This will be violation of support and resistance, violation of days high and low, and violation of pivot highs and pivot lows. Bull traps are supply zones where conventional technical analysis people will make novice buying mistakes. In conventional technical analysis, price closing above an area of resistance is considered as a buy signal. Therefore, people who start buying at the violation of resistance are making two key novice mistakes. 1. Buying after a rally in price, and 2. Buying in an area where chart has proven to us that in history, supply exceeded demand. Bear traps are demand zones where conventional technical analysis people will make novice selling mistakes. In conventional technical analysis, price closing below an area of support is considered as a sell signal. Therefore, people who start selling at the violation of support are making two key novice mistakes. 1. Selling after a drop in price, and 2. Selling in an area where in history chart has proven to us demand exceeds supply. Let's look at an example. On the chart, we have a rally base drop supply zone which is just above an area of resistance. At the break of this resistance, people who follow conventional technical analysis will start buying due to breakout, thereby making two novice mistakes. 1. Buying after a rally in price, which means buying at an expensive price, and 2. Buying in an area where in history chart has proven to us that supply exceeded demand. The supply zone worked as a trap. The next advanced booster is level on top of level. To qualify a zone as a case of level on top of level, an intermediate time frame zone should divide into multiple zones on the lower time frame. At times, we see multiple levels of supply on top of each other. We select the lower zone since it has more strength. When price starts retracing, the lower zone which was showing higher quality gets violated, and the upper zone which was showing lower quality gets respected. Similarly, in case of multiple levels of demand on top of each other, we select the upper zone since it has more strength. When price starts retracing, the upper zone which was showing higher strength gets violated, and the lower zone which was showing lower quality gets respected. The reason behind this is that the zone was a case of level on top of level. Let's understand how to qualify level on top of level. In case of supply, level on top of level is an intermediate time frame supply zone which gets divided into multiple zones on lower time frame. When price reaches the upper zone, most of the demand due to which prices were moving up is absorbed by the lower zone. This creates bigger imbalance between demand and supply, and the probability of the upper zone increases. In case of demand level on top of level, an intermediate time frame demand zone will get divided into multiple zones on the lower time frame. When price reaches the lower zone, most of the supply due to which prices were moving down is absorbed by the upper zone. This creates bigger imbalance between demand and supply, and the probability of the lower zone increases. In case of supply, we will use the upper level, and in case of demand, we will use the lower level. Let's look at an example. On the left, we can see an intermediate time frame supply zone, drop base drop. This supply zone on lower time frame is getting divided into two supply zones, drop base drop and drop base drop. Therefore, it will be called as a case of level on top of level. In case of supply level on top of level, we will use the upper zone. The next probability booster is coinciding levels. When a lower time frame zone coincides with an intermediate time frame zone, it is called as a coinciding level. This adds probability to the trade setup since your location becomes very high or very low on intermediate time frame, which adds intermediate time frame zone support. Example: 15 minutes lower time frame supply zone coinciding with 60 minutes intermediate time frame supply zone. On the left, we can see a rally base drop supply zone on the lower time frame. On the right, we can see a rally base drop supply zone on the intermediate time frame. The lower time frame zone is inside of the intermediate time frame zone, therefore it will be called as a case of coinciding level. This is Surjit Kakkar signing off. See you in the next lesson.